So we began our program tonight by telling you about the Federal Reserve's decision to raise interest rates today, and we finish up tonight with a look at what higher rates could mean for your budget. And to do that, we are joined by our personal finance correspondent, Sharon Epperson. So where do we see the first line impact on our budget here?
Well, when you look at what you're paying and the interest that you're paying on various products, let's start with credit cards. You're going to see a significant impact, almost the same amount of impact that we're seeing in terms of the rise that we've seen in the Fed funds rate. Look at what's happened to credit cards. Look at what's happened to auto loans. Auto loans not as great an increase because we aren't seeing that as tied to the short-term Fed funds rate. And then, of course, the bill that you really need to pay yourself every month to yourself for savings, well, that's not really budged at all.
No surprise.
Right. Why does it always work that way?
It does work that way.
What should people do right now? Because if the Fed may have 2 more interest rate hikes in its pocket, so what should they do now?
Well, we're looking at the average credit card rate right now already near 17% at a record, and it's going to continue to go up. So you need to know what your credit card rate is. Many borrowers have no idea, and it's important to know that rate just so that you know how you're going to budget to pay down that rate as well. You also want to shop around and see if you could get a lower rate, whether it's on your credit card or maybe some other adjustable rate that you have on an adjustable rate mortgage or home equity line of credit. See if you can lock in a lower rate and focus on that variable rate debt, because that is the debt that's going to continue to rise. You always want to try to get a fixed rate loan if you can, but if you're talking about variable rate, that's what you need to pay down first.
Now, we laughed about the savings rate number. It's not going up all that much.
Right.
But seriously, what can savers do to try and maximize their returns here?
Yeah, well, once you've paid down this debt and you're starting to pay down your debt, you want to put that money towards savings because you still need that emergency fund and you can't get more money on it. You need to shop around. The average bank savings rate hasn't increased that much, but online banks offer a much higher rate, and you may get a rate there of close to 2%. Short-term CDs, just 1 year, you're just tying up your money in a certificate of deposit for that long, could be 2.5%. So that will give you a better deal too. But again, sometimes these are teaser offers. They don't always last that long. You want to make sure that whatever rate you're getting on that savings is really going to last you for as long as you need to.
Sharon Epperson, as always, thank you.
My pleasure.
See you later.